You seem tired of staring at those dreaded tax forms. Are you confused about deductions, credits, and brackets? Well, it's okay. It happens. Tax season can be a real headache. Today, we will break down the odd spots of taxes into simple, understandable terms. From understanding why you pay taxes to figuring out how to maximize your refund, let's make it easier for you. Let's start with the basics. What are taxes and why do we need them? In the United States, we rely on taxes to fund essential public services like education, postal services, law enforcement, healthcare, and investments in technology and innovation. To pay for these services, Americans contribute through taxes collected at both the state and federal levels. For example, state taxes might fund local fire departments, while federal taxes support the military. Our tax dollars also support international relations and military efforts, which benefit the nation through global trade, supply chains, and strategic partnerships. Now let's talk about how the tax system works. Ideally, everyone would pay their fair share, but a flat tax rate isn't fair for everyone. For instance, a 30% tax on a $200,000 income leaves plenty of money, but the same rate on a $40,000 income leaves barely enough to survive. To address this, the U.S. has a progressive tax system. This means people with higher incomes pay a higher percentage in taxes. This approach helps ensure that everyone contributes based on their ability to pay. So, now we know that people with higher incomes pay higher tax rates, making the system fairer. But how can we calculate taxes? Now, let's calculate your taxes. It's based on your taxable income, not your total income. Taxable income is what's left after subtracting deductions. Everyone gets a standard deduction, which varies based on filing status. For example, here are the standard deduction amounts. Single or married filing separately, $14,600. Married filing, jointly or qualifying surviving spouse, $29,200. Head of household, $21,900. For example, if you're single and earn $40,000, you'd subtract the $14,600 standard deduction, leaving $25,400 as your taxable income. But there are other deductions that can lower your taxable income. Tax deductions are expenses you can subtract from your gross income to reduce your taxable income. This means you'll pay less in taxes. There are two main types of deductions. 1. Standard deduction. This is a fixed amount determined by your filing status. We've already covered this. 2. Itemized deductions. You can itemize your deductions if they exceed the standard deduction. Common itemized deductions include mortgage interest, state and local taxes, charitable contributions, medical expenses. If they exceed a certain percentage of your adjusted gross income, you choose whether to take the standard deduction or itemize your deductions. Whichever amount is higher is the one you'll use. Anyway, to simplify the process of calculating your taxes, you start by taking your total income and subtracting all your qualified deductions. This gives you your taxable income. From there, you'll calculate a tentative tax owed based on your taxable income. However, before arriving at your final tax amount, you must also consider tax credits. This is why it's important to understand the difference between tax deductions and tax credits. Tax deductions reduce your taxable income, which in turn lowers the amount of taxes you owe. For example, if you earn $50,000 and have $10,000 in deductions, your taxable income would be $40,000. On the other hand, tax credits directly reduce the amount of tax you owe. So, if you calculate that you owe $5,000 in taxes, but you have $1,000 in tax credits, your final tax bill would be reduced to $4,000. Understanding both deductions and credits is important to accurately calculating your taxes and potentially lowering your tax bill. Now, let's talk about tax incentives for businesses and investors. Taxes aren't just about collecting money, they're tools for shaping the economy. By offering tax breaks, the government encourages job creation, housing development, and economic growth. For instance, businesses can deduct expenses like vehicles, travel, and meals, and they get credits for job creation. These incentives benefit everyone: entrepreneurs, investors, and the overall economy. While tax benefits can be a perk of entrepreneurship, you need to remember that starting a business should be driven by passion and a belief in your idea, not solely by tax advantages. Tax evasion can lead to severe consequences. Beyond deductions and credits, entrepreneurs and investors can leverage different income types. Earned income comes from active work, wages, salaries, self-employment. Unearned income comes from investments, interest, dividends, rental property, pensions. Earned income, especially W-2 wages, is often subject to higher taxes due to payroll taxes. Self-employment involves paying both employer and employee portions. Unearned income is generally taxed more favorably, with some types like qualified dividends taxed at lower capital gains rates. For instance, certain types of unearned income, such as the sale of assets and qualified dividends, are taxed at a special capital gains tax rate. So, you might be thinking, wait, if I don't work and only earn passive income, I pay less in taxes? That's exactly right. Of course, it takes a lot of active work and earned income to reach a point where you can make investments that generate unearned income. But if you're aiming for financial freedom, the ultimate goal is to transition from being an employee to becoming an investor as quickly as possible. This is what many consider to be the American dream. All right, let's finally discuss how to file your taxes. If you're employed by someone else, you'll receive tax forms from your employer to report your income. These will typically be W-2s and 1099 forms. Additionally, if you've made any investments, you should receive tax forms reporting both your income and any tax deductions. Once you have all your tax forms, the next step is to answer some questions on your tax return, which might reveal additional tax deductions or credits you qualify for. After entering all your information correctly, and accuracy is key here, you'll determine your total taxes paid. By the end of the process, you'll know whether you owe more taxes or if you're due for a refund, as we discussed in number earlier. Now, some people aren't satisfied with their tax refund or tax liability after filing their return. If that's you, let's move on to how to build a tax plan. Effective tax planning involves proactively determining how to optimize your taxes to achieve your desired outcome, whether that's reducing your overall tax liability, reinvesting in your business, planning for retirement, or building more streams of passive income. You can shift your taxable income to align with one of these goals. Here are the steps you would like to follow. Step 1. Understand your tax bracket. This is paramount because if you're not making much money or paying a lot in taxes, you might not need a tax plan. However, if you are, it's important to understand your tax bracket and how shifting brackets can save you money. Step 2. Understand tax deductions and credits. This step is knowledge-based. It's about knowing which tax incentives are available to you and which ones will help you meet your overall goals. Step 3. Understand your total tax. You can reach a point of diminishing returns where you've already eliminated your tax liability. In this case, you might be doing more than necessary. Step 4. Choose your tax strategy. There are many strategies to optimize your tax situation, such as maximizing deductions, optimizing legal entities, retirement planning, insurance strategies, legal loopholes, niche-specific strategies like investing in real estate or oil and gas, and other advanced tax planning strategies. However, you don't need to implement all these strategies, especially if you don't have much taxable income yet. Sometimes, one solid approach is all you need. For example, there are actually people who wipe out their tax liability simply by investing in rental properties. Step 5. Implement your plan. This is the most important step. After selecting the tax strategies that best meet your goals, you must put your plan into action. As they say, a goal without a plan is just a dream. This might mean setting up different accounts, such as retirement or health savings accounts, making investments in real estate or oil and gas, or budgeting business expenses for the year, and so on. We hope this gives you a clear summary of how to build a tax plan and breaks down taxes for beginners. You've covered a lot of ground here. You've got a good handle on the basics of taxes now. This is a great start. Keep exploring and learning, and you'll be a tax expert in no time.